Welcome to my podcast where I talk about all things related to money mindset, finance, business, and investing. My name is Royston Cumberbatch, a qualified accountant with over 30 years' experience in finance and business. Coming from a very humble background, I have continuously challenged the assumptions and the expectations of what I'm capable of achieving for myself and others. Over the years, I've helped hundreds of entrepreneurs to decipher finance and to make more money and to run highly successful businesses. On this podcast, I will share with you tips, strategies, techniques, and tools that you can use to make more money, manage money better, and to maximize your success.
All right, welcome to another episode of the Financial Intelligence Mindset Podcast. We bring you different people from different backgrounds every day, every week. I try to have different people with different perspectives. So today we got Phil Blows, and Phil is actually a man with a finance background, which is really to my heart. More like in financial trading, you can invest your money with him and he can help you to get more returns. His background is actually in banking and helping more financial institutions to leverage their money. And he's actually written a book as well called The Money Triangle. And to write that book, he actually interviewed 10,000 people. Wow. So welcome, Phil. Please tell us about your backstory. Maybe how do you really get into this financial trading stuff?
Yeah, thanks very much for having me. It's a pleasure to be here, and very supportive of your mission to try and make anything financial more accessible to people. So thanks for taking the time. In terms of how I kind of got into finance, I've always been quite a big fan of sort of maths and generally sort of financial trading. And it really happened at university, where I think it's probably reading a lot of books. I stumbled across some of the real early kind of finance books, things like Market Wizards by what's his name, Jack Schwager, I think his name is, but and a few others, and just got the bug really early and just loved the idea of trying to solve this massive problem, which is, how do you make excess returns in the world of finance and investing? And caught the bug really early, despite doing a degree that didn't really have anything to do with finance. Once I left university, I was very quickly moved into a foreign exchange brokerage firm, which was helping people who were buying properties abroad to get the best rate for their money. Did that for a while, then moved on to a more of a trading desk, where I was effectively helping retail investors invest their money into stocks and shares, as well as kind of FX strategies. Was really fortunate in a couple of things where my boss's boss left. I ended up running this kind of 30-man company when I was about 21, and we built up this huge business of lots of clients and got lots of really early exposure, which was awesome. And then kind of moved that to a different company, and I guess over time it grew and grew, and we ended up with kind of managing institutional money as well as retail investors' money. It was just a very, I guess, a lot of early responsibility, which was brilliant, but also a lot of continued learning, always taking I had a lot of financial exams I needed to take, and I've always been passionate about reading a lot. And I think given how much financial markets change and how quickly, especially now, it's never been more important to really just try and stay on top of things.
It's amazing. So that's quite great. So it sounds to me like coming out from university, were you like interested in numbers? Were you interested in finance? Were you a maths guy or?
I wouldn't say ever so much of a maths guy. It was quite interesting because I think when I was at school, the two subjects I really struggled with were French and maths.
Yeah.
And I ended up for 6 years working in finance in a French-speaking country, which was a bit of a joke.
Interesting.
I moved out to Switzerland for a while, but I think it's less. It's not. Finance doesn't tend to be very complex maths. I think it's more.
Of course,
it's more
arithmetic.
Yeah, I think so, and it's and I don't know, the kind of it does appeal to me. It's very binary in the kind of the returns that you get and things like that. So I've always quite liked that aspect, and designing systems that look at kind of trend following or prediction systems, which work fairly well at times, was also quite a big draw to me. It just sort of made a lot of logic sense, I think.
Yeah, cool. So what did you actually study at university?
So I did geological sciences, which actually had a fair. I mean, I think when I started that, I was very much around. I just wanted to spend my life outside, I think, and that's why I thought trekking around volcanoes outside would be a great career.
Interested.
Yeah, but I did an MBA about 10 years later.
Okay, yeah.
At the University of Geneva, which kind of helped with a bit of the on the business side, I think.
Yeah, that's great. Talking to you as I was kind of thinking about my son, right? Because my son is 16 and he's very good in maths. And before he wanted to do engineering, but then he said to me, Daddy, I think I'm going to do maths and maths and something to do, maths and computer science.
Yeah.
And geography and something else, you know what I mean? And I think, and economics as well, or whatever it is. So I think he's really, seeing himself now as going more into like working in financial institutions, like, like building systems, etc. So as you were talking, I can picture my son kind of following in someone like yours footstep. So I'll make sure that he actually listens to this podcast. He might pick up a few gems.
Yeah, I mean, the computer science is certainly where the majority of finance is now rooted. And I think you often find the really good computer scientists have such a clarity of thought and clarity of logic into how they do things.
Yeah.
That it really is a fantastic grounding for really any career because of this. It teaches logical thinking.
Correct.
But now, I mean, especially when you're looking at kind of the emerging markets, I'm more involved in now, like cryptocurrency trading and investment in cryptocurrency. You're seeing that underpinning all of that is a lot of new kind of, I say fairly new things like computer languages such as Solidity, which is, if you become proficient in that, you're the most in-demand person right now. They'll try and steal you well before you get to university. And
of course,
indeed, we're seeing founders in the crypto space launching billion-dollar companies who are under the age of 16.
Wow.
And it's stuff like that. The Rari Capital guys and people like that. It's a phenomenal time.
It's amazing. And it's amazing that you actually talk about that, because I said to my son before, like he always used to be on his phone, like I said to him, stop playing these games and learn to build something, you know what I mean? I mean, it's probably still haven't actually sunk in yet, you know what I mean? But I guess maybe it will eventually, because he's so bright, but then, his talent is underused, you know what I mean? And
I think that there's a lot to be said for kind of being very generalist early on. I think. Yeah. I've always found that in my career when I've gone down paths where things have begun to get very specialized, which happened when I actually moved out to Switzerland. I ended up, I was helping banks manage their sort of liquidity of their foreign currency reserves, but I found I was getting more and more specialized to the point where I was doing kind of derivatives in Russia, in the Russian markets.
Yeah.
And it was this tiny market, which at any point could go wrong. I mean, for example, we found that business really dried up for us when Russia invaded the Ukraine, because every investment bank all of a sudden couldn't invest in Russia because they were sanctioned. So the more we were so specialized and so niche at that point that our business got hit by an event completely outside of our control. So I think that's kind of why I rebelled against that a little bit. And then, we did an MBA, which is probably one of the most generalized kind of fields of study you can do. And then went more into fintech, which kind of opened a few more doors after that. Yeah,
that makes sense a lot. That makes sense a lot, because like I have an accounting background. I was doing accounts like in London City, and I was like, man, I hated doing reporting every month, same thing every month. And I don't want to do that. I did an MBA as well, and then I kind of branched off into what is called transformational work, doing different work. And I also didn't want to be pegged down into like just one company, one process, one job, you know what I mean? Because it does make you into like a very specialist, you know what I mean?
Yeah.
So well done on you for being a generalist. That's quite good. So you said your first job, right? So then now that you've done this, whatever you did at university, and then you're in this first job that now requires a lot of maths, etc., right? And a lot of, as you said, logical thinking. I mean, how did you first find your feet?
I don't think it was because it was such an interest. The financial markets I found interesting. I found it very easy to kind of dive into the detail, and what otherwise would probably be seen as quite a dry topic.
Yeah.
So in terms of numbers and things, it was just doing FX calculations. So if I have £100,000 and I need to buy dollars, what's the buy price, what's the sell price, if we're adding a margin to it, what is that, and it's not particularly complex maths, but it you just get used to it. And I think then learning more around what impacts the price, that price, so then getting into kind of the effects of interest rate, I don't know, it could be anything at the time, whether markets are risk on, risk off, that sort of thing, and how that impacts any individual currency. And then just general institutional flows and things like that. So the more you kind of dig into it, the more I guess, if kind of more questions get raised, but as you answer those questions yourself, you inherently learn more and more about it.
Makes sense. So let's get into the mindset of investing, because a lot of people, I think, when they hear the word trading, they're like, oh, that's risky. Or they heard the word investing in the stock market or crypto is risky. You know what I mean? So if there was someone right now who, like, you were speaking to them about investing and they're like a very risk averse person, how would you talk to them about the benefits of, say, investing or managing their, how would you make them feel comfortable?
I think it's for me, and it will always be different for other people. I mean, I would always use an example of, say, something that's highly diversified, like the S&P 500. So the S&P 500 is the US stock market index that tracks the 500 largest companies in the US. And on average, if you look at it over the last 100 years, it's returned somewhere in the region of 7% a year. Now, some years it's done 50% up, other years it's done 30, 40% down. Yeah. And the thing that kind of, for me anyway, gives me comfort in the region where I am fully, anything that's not in crypto for me is fully invested in equities. I don't hold any cash if I possibly can. Yeah. And the reason being is I know that on average over the last 100 years, you're going to get 2 to 3 drawbacks a year of around about 10%. Yeah. In equity markets. And on average, you're probably going to re-achieve a new high within 3 to 6 months. Yeah, so, like that. Those are never really, those little dips. And then every 5 to 6 years, you're probably going to have something that looks more like a bear market. And what a bear market is on average, it's a drop of 32%. So on average, the market will drop 32% at some point. And again, it takes something like 18 months to 2 years to re-achieve a new high. And you can have these long periods where things go quiet, but look, we're looking at a 100-year average in all of this. And obviously, you've got things like depressions in the early 30s. You've got big stock market crashes like the 87 crash, what happened in 2008, all these sorts of things. But for me, it probably is because I like numbers. I kind of look at the long-term averages and I'm saying, well, I'm not going to really try and time the market. Obviously, if the market crashes and it just so happens I do have some cash, I'm going to be quite aggressively buying into it. Yeah. And that's what happened with, it was interesting with what happened in
last year.
With last year and COVID.
Yeah, March, yeah.
Yeah, the peak to trough was around 32%, pretty much near that kind of that long-term sort of bear market average. And it wasn't, but it was a bit of a crash. So if you're looking at it and thinking this doesn't feel like a 10%er, it feels more like a 30%er, you would have been pretty comfortable buying at those levels if you've got a long-term holding mindset.
Correct.
The thing that really gets people, and this is trading versus investing, is if you've got to pull the money out within the next couple of years, you probably shouldn't be in equities anyway. You should just put it in cash, put it somewhere safe, don't worry about it. But if you've got a 5-year plus horizon, then you can afford to take some risk with that.
Of course.
That's what I do. But, again, nothing's worth staying up at night and worrying about. So if you're uncomfortable with any level of risk, then, it's just not worth having any exposure on. Just put it all in cash. It's going to be detrimental, but, nothing's worth worrying about. So
I like I like the way you said it, and maybe I run this by you and see how you think about it, because I've got my own blueprint. I call it the profitable business blueprint that I use for consultancy clients, right? And then I've got one of my modules is called the financial risk formula. RISK is an abbreviation. And under I, which is investments, I have a subsystem called rate. I say whenever you're investing for a rate of return, but rate is actually an abbreviation. And I says, okay, the rate now is that first, the R is your risk appetite. Because if you invest in, whatever you're going to go into, you have to work with your risk appetite. As you just said, if you have a very, very, very low risk appetite and you don't want to lose anything, hold it in cash. But if you think and you understand the risk reward theory, and you said, okay, I'm happy to invest, happy to lose or happy to win, on average, you might get 8% on equity market. So that's why I say your risk appetite is important. Then I have A is the amount. Because to me, the more you invest, the more you're likely to win or potentially lose. And T for me is time period. And I think the longer you're willing to invest, then the less you have to worry, I believe. Yeah.
Yeah.
And then E I have as the expected amount. I think you should always have an expectation of what you're going into. So me just describing that rate system, does that work for you? I mean, like someone.
Yeah, no, I think it does. It's a very sensible way of looking at it, and anything that breaks it down like that, I think is very useful.
Yeah. Cool. Yeah. So, all right. So I kind of got what you're saying is obviously work out your risk appetite, work out your time horizon, because most of all it bounces back, right? And then you mentioned, you mentioned about index funds and S&P 500. So if somebody had, let's say right now, they had 20,000 to invest or 100,000 to invest, and they wanted to go into the stock market, would you say to go onto one stock or go into a fund or go into a basket like an ETF? I mean, how would you go about?
I mean, it's this one thing I kind of covered when I wrote a book about sort of the investment section of the money triangle. This is very much what I kind of covered there. It's sort of the biggest killer with most investment vehicles is cost. So
I like that.
And actively managed funds, or the high 90% kind of underperform the index. So they're higher cost and they don't deliver what they say they're going to deliver. So usually when people ask you this, I just say you can't really go that wrong with a low cost S&P index tracker.
Yeah.
Okay? Obviously, you've got dollar exposure there, which I'm personally comfortable with. Not everyone is, but I think that to me is one of the biggest things that I've looked at. But you try not to time things because you never know what's going to happen with the markets. But if I would be loath right now, as equity markets are right at their peak, to put the full amount in at this point. I'd be looking for one of those 10% kind of pullbacks.
Yeah.
I don't think we're anywhere near a bear market right now with the amount of kind of government money being printed. But it's I think what I'd be expecting to see is just drip feed stuff in every month, over the next kind of year or so, and hopefully you'll catch a bit of a pullback in markets as they come off.
I like that. I like that. That's quite good. Okay, so your book, the money triangle. Can you talk to us about that? I mean, can you describe it? I mean, what is the money? What is the money triangle?
I mean, it was really simple because, as I said, I was fortunate to spend 4 years kind of launching this AI-driven tool that we'd built at a fintech that I was working at, which was designed to just run people through a really short survey and kind of get an idea of where they are at with their finances, and then signpost them to the right places to kind of sort it out. So, we'd be looking at how they manage their debt, what kind of money they had in the bank, how they spent what they had each month, that sort of thing. And I think, on the back of that, I actually was running around the country, the UK, and I spoke to 10,000 people at least over 4 years and ran them through this tool, as much to try and get an idea of how we can improve the tool, but also just to learn more about individuals and how they manage their money.
Yeah.
Which is a real crash course. And I think on the back of it, that's where the money triangle came out was, there was so much repeating stuff that kind of would come. Every conversation I had, you'd pick out these trends. So it really is sort of the three sides of people's finances, which is how you earn it, which is a big part of it. If you're not earning very much, you're not. There's not a lot you can do.
Yeah.
How you invest it is clearly very, very important as well.
Yeah.
And that's kind of the linchpin of what you're doing, and then obviously the final one is how you spend it.
I like that
because it's spending, because if any side of the triangle is kind of out of whack, long-term financial wealth just doesn't appear. So there's loads. Everyone's got an example of a friend who earns a fortune but is broke at the end of every month because they spend too much. There's the example of people who earn a lot but don't invest it in a very efficient way, so they they end up not making as much as they should over the long term.
Yeah, not growing the wealth.
And then, you get this this same thing around, you've got, there's a certain level that people have to earn in order to kind of, be able to invest as well. So there's a bit of, and that was quite an interesting section, because it's often one that in finance books people don't cover, is kind of the earn section, because people always say, well, if you want to earn more, just start a side hustle and get on with it. And what I kind of found is the easiest way for most people to earn more money is just to do to work really, really hard at what they're doing now and get a promotion. It generally works higher, and often asking people, look, are you the highest paid person in your position in your company? And if they say no, it's like, well, why not? Why is it because you're not working hard enough? Is it because there's something unfair, an unfair advantage that someone else has, in which case maybe you should be looking to move somewhere else? And before you start looking at side hustles, which generally fail because they're not easy to do, otherwise everyone would be doing them.
Yeah.
Make sure you're earning as much as you possibly can with your day job. So that was sort of one of the things that came out of interviewing.
That is solid advice, man. That is solid advice.
Yeah.
I quite like that. So when you think about like something that like the Robert Kiyosaki cash flow quadrant, right, where he talks about you could either be an employee or self-employed on the left hand side, right hand side, a business owner, investor. From an earning money perspective, and obviously you made a good point. In your job, try to earn as much money as you can. Actually, and I had this theory a long time ago, because I actually read a book, 15 years ago, called the Linchpin. And I was actually saying in the book, what you want to do in your company is become that linchpin that, like that if they pull you out, things will be in a mess, right? You're small, but you're still very, very important. And by doing that, then you obviously, you can be important and be noticeable. So go back to the cash flow quadrant, employee versus business owner. I mean, now that you've gone through the cycle yourself, which one would you say is the best way to sort of earn money and build your wealth?
I mean, there's no bigger wealth creation event, I don't think, than if you start a successful company.
Yeah.
That is the number one way to do it. It's taken me 15 years to find something that I wanted to actually, I believed in enough to throw in my career and, take a big salary cut, because, you get to the point then when you're quite new, and we're a very new business. Yeah. That you become asset rich, but very cash poor.
Yeah.
Which is, so you might have a good like net worth potentially, but unless there's a liquidity event, you're in pretty dire straits until you can sort of realize it. But speaking personally, the biggest event for me is founding a business. And I think, but I've got 2 kids. I've got I had 3 mortgages. I've had to sort of offload a couple of properties and things like that to get where I want to get to. And it's you've got to get into a position whereby you can focus on the business and not be so stressed because you've got no cash to live off. So it's taken me a while to get into a financial position to be able to launch a company. Because I don't think I had the skills to do it properly in my early 20s, when I was a bit more unencumbered and lower cost of living, all that kind of thing.
I like what you said. It's actually comforting, because like sometimes, like I had a career, like to say, in London, financial transformation work, consultancy work, project management. I did all that kind of stuff, and I decided to give that up to launch my own like online academy, my own online training business, which I'm running now. I mean, obviously, alongside that, I do consultancy as well, like for companies who are making a lot of money. But as you said, and I like what you said, actually, there are people who make money in business but don't keep the money.
Yeah.
Because they're just not making enough. They don't have enough the right operational processes, right financial management. There are people who make profit in business but don't invest the money. So through my own academy, I call it the FBI Academy, Finance, Business and Investing Academy. It's all about giving business owners more intelligence, right? And I actually had to take a cut, as you said, in my earnings, to establish the company, establish the business. And it's really fulfilling, because as I said, here I am in the Caribbean, you kind of work at your own pace, you know what I mean? But at the same point in time, you still have to manage your money even much more better. Now, when you're an employee, you get a fixed amount and all that kind of stuff. Yeah. All right. So talking about the mindset of a bit, now that you're a business owner, then if there's anyone who is looking to take the plunge, as we call it, or go from employee to business owner, what are some of the things that you have experienced that you say to them, look out for this, or have this in place, or before you launch a company, you must do X, Y, Z? Yeah. What's some of those things?
I think I spent some time raising money for other startups with a previous job, previous sort of side hustle actually, which was work for kind of Europe's largest like tech meetup community, and we would help startup founders get kind of first checks and things like that. And I think the biggest thing I think you need to have in place is product market fit, or at least some real reason to think that your product is going to work. Yeah, because and it's and it needs to be tangible. It's not like I spoke to 10 people and they all said that it was a good idea. It's like, well, if your business is getting money out of people, like, have you got people to give you money already?
Yeah.
In terms of like, have you managed to get them to sell? Have they bought something properly from you? Have they bought a service from you? Is there, before you, and you can do that in the leanest way possible, and look at, reading the lean startup and things like that, where you have the minimal viable product, all these sorts of things and strategies. Prove to yourself, because you're going to need it when it's things aren't going so well. Prove that people want the product in a way that people can't really argue with. So I look at the new business that we've got now. I was thinking I needed to raise huge amounts of money just to get it off the ground. But chatting to a few people, just talking about my idea, they were saying, well, which is effectively it's a crypto wealth management platform. We pay people a fixed interest rate on Bitcoin, on Ethereum, if that's what they hold, or if they have kind of dollar pegged assets, which tends to be the thing that people are more interested in. So it's effectively a dollar account, and we'll pay 15% interest on it.
Yeah.
And it's done via staking those coins and generating yield, because it's a huge. The returns are crazy at the moment because crypto markets are incredibly popular
and volatile.
So we don't think it's going to stick around forever. But it's I was talking about that service with people, and they were saying, well, yeah, I would obviously do that. And I said, well, do you want to do a trial then? And friends and family were giving me money to say, okay, well, start managing it. I don't need a platform to begin with. Send me a weekly email that says what the performance is, and started there. There's like, okay, well, we've now got 50 people who've parted with cash and are saying, I want to give you more. Will you take more? You think, well, that's a real proof point, right?
Yes,
there.
I love it. I love it. Yeah,
this is something that people want and will pay for, and and then that gives you the confidence just to keep taking more steps after that. So, product market fit. The two reasons why most startups fail is it's product market fit and it's lack of money.
Yeah.
So,
or lack of money management as well.
Lack of money management, exactly. They overextend themselves completely. These sorts of things. So, I've always got those in mind now, and making sure that we've gone through a kind of a seed round where we've raised capital, and making sure that it's enough to give us a significant runway to get to the next step where we'll raise more. So yeah, it's. I think that's what you really need to do as a first step. Really prove it works, and it will force you to really make what your idea real.
Yeah. It's great to actually hear you say that, because I actually said I have my group coaching program, and what I said to people is that one of the first things I actually teach them to do is I said profit is a reward for creating value. So your business needs to be a value creation business, right? So how and creating value is all about giving the customer something that to them is very valuable. Are you solving a problem? And or either you're relieving a pain or you're increasing a gain, right? And once you're doing that, I think, and it's a good offer to someone, and it goes, wow, this is value for money. Of course, you obviously don't need a website. You don't need a lot of stuff. What you need is a good offer, and it goes, wow, yeah, I'm willing to give it a go.
Yeah, I think it's a really, really good way of putting it. Yeah.
Yeah, and then you're in business. All right, cool. So as a finance man yourself, I mean, have you had any financial setbacks, any financial losses? Have you made money mistakes with money? I mean, you seem to be quite good with financial stuff. So have you had any money mistakes? Or in hindsight, if you look back, say, I don't know, at things you've done now, would you have done anything differently financially?
I think, obviously it would be nice to say I would have bought Bitcoin really early. But,
Yeah, I know, yeah.
These sort of silly things are, I bought Bitcoin at 5,000 and sold it at like 8,000, I think.
Why? What happened there?
Well, it's like I didn't buy it on the way. I saw it go to 17,000 or so in 2017, and then collapse. And then I thought, well, I'll buy some at 5,000. Then when it kind of made 50% in over the course of a year or less than a year, I thought, well, I'm not really sure, so I'll take some profits. I periodically then bought more regularly, but the first amount that I bought, I sold very early. But there's obviously loads of things. Like I used to trade a lot with my own money. Whilst I had a full-time job, and I think I did all right out of it, but I would have done would have done almost as well if I just chucked it all in an S&P tracker earlier. So I think I think what I think I could have done a lot better if I was doing it full time, but I wasn't in a position to do it with my own money. I also, when I was in Switzerland, I gave some money to a financial advisor who, looked at a very tax efficient sort of structure for me. And then when I went to remove the money, there was a 50% cost to remove it.
Sure.
So basically it was just I got scammed. They're a company that call themselves the world's largest financial advisor firm, but I've seen them just sell predatory products to loads of people. So I think that was me being time poor at the time and just wanting someone else to kind of take control of a portion of my finances, and I just didn't. I got scammed basically. So there's those sorts of things, which I'd certainly read the small print when I'm dealing with a third party a bit tighter. But overall, I think I've been quite lucky.
Yeah. So what was the biggest lesson? If you're going to advise someone who was going to, as you said, look at investing, if you was going to basically all the mistakes that you made, what is the one thing you would say to someone before you invest? You must do what?
Good question. Before you invest, I quite like your idea of saying have an end in mind, or at least have a target.
Yeah.
Because it is true that you work out what have a plan basically is the main thing.
Yeah.
So often it's saying, okay, so if you want to retire at 60, say, how much do you need to what's gonna be the catalyst for you to be able to retire? Is it being able to earn X per month passively? So okay, so if you're looking to earn X passively a month, at the moment you're going to need this amount built up to do that. So let's work back to today. So that means you need to put in this amount per month, and and then you can show them that if they're fully in equities, you can probably expect it to take this long, or to put this amount in. If it's in cash, it's going to be this long. And then go through your risk profiles, those sorts of things. So something that a good IFA would do is to really go, financial advisor, to say, let's create a real plan, and also look at kind of when the significant other events might be, like paying off mortgages, putting kids through college, those sorts of things.
I like that. Yeah, have a financial game plan. I always think of it like chess. I'm a big fan of chess. Start with the end in mind. You know what I mean?
Yeah.
When you're playing chess, you're only playing for one reason, to checkmate the king. Every move you make is about checkmating the king. So if you invest you're investing for a return, and so think of do your due diligence and all that kind of stuff with in mind that you don't want to make losses. And I always say to people, investigate before you invest. And what would you say is your biggest financial, success, or as a finance man, I'm really happy I did this thing, or it resulted in something big for me. I mean, other than obviously probably starting your company, which gives you.
I think it was. It's the amount, it's the investment of time and kind of resource into learning about cryptocurrency, because it's got a terrible reputation, and rightly so, in certain areas. That most people look at it, they hear about the scams, they hear about the hacks, they hear about all these sorts of things. And I looked at it as a way of, as something that looked interesting to begin with.
Yeah.
And the more you dig into it, the more you realize the kind of potential that it's got. And I think starting to invest in it in the way that we did, which was looking at these, what we call stable coins, which are attached to, they're cryptocurrencies that are pegged to the value of the dollar.
Yeah.
And then using those assets to generate income by lending them, by whatever it is. And it's not without its risks, but finding a way where you can generate a pretty consistent return that's 2, 3, 4 times what you would expect in an average year in equities is unbelievable. And I don't know how long it's gonna hang around for. We think it's gonna hang around for some time, and it's definitely going to be over and above what equities return on average for quite some time.
Yeah.
But that is a game changer, and the fact that it's available to everyone anywhere in the world, and there's very little barrier to entry to get going with it. It makes it a phenomenal, wealth creation tool. And I think, I'm absolutely passionate about trying to, and that's what we do as a business at Accru, is be the layer that takes all of this complexity and turns it into a safe, insured, regulated environment where people can just access these returns. So it's something that I think, exploring that angle was the best decision I think I've ever made financially, because it's so new that in a year of study you can become an expert in it, or at least understand it better than most people who are in the market. It's not kind of like traditional finance where there's people with 50, 60, 70 years experience of investing. It's things like decentralized finance have only really been around for 18 months.
Yes. So it's new and emerging, yeah. So I guess that you always reading, I think you mentioned that you obviously like to read. So I guess you always reading books, you always researching, you always keeping yourself up to date. Am I correct?
Absolutely. And you've got to enjoy the process. I think that's why you've got to work and do something that you enjoy. I mean, I imagine most people would be bored to tears with my reading list.
Yeah.
But it's the stuff I find interesting. And I think if you don't find yourself reading around the topic that you spend your time working in, just naturally, I don't think you're potentially in the right industry.
Yeah, I agree.
You've got to want to learn more and get better. And
of course. So how often do you read? I mean, how much books do you read a week, month, year? I mean, what's one of the best books you've written on the topic?
I mean, it really varies. I mean, because there's new ways of kind of consuming books. I've found these days. I've recently got quite involved with Lucid, which is an app that kind of distills books into, I think you've probably seen Blinkist. It's sort of a competitor to Blinkist, where it distills books into graphical kind of 10-minute digestible shortlist type things, and it's
wow.
That's really good. So you can look at it, you can digest the main points of say 50 of the top kind of self-help books ever in that area. In terms of finance books, the one I think everyone should read very early on it's a book by a guy called Joel Greenblatt, who is a very successful hedge fund manager, and he wrote a book that's kind of cheesy title, but it's called The Little Book That Beats the Market. Cool. I think he followed up with The Little Book That Still Beats the Market. And it just talks about value investing and about how to analyze businesses or just investment opportunities. And the way he breaks it down is phenomenal. And I think I think we've seen the model break down. I don't think it is doing as well as it was, that kind of investing, but the mindset it creates around looking for undervalued businesses and looking for businesses that have very high return on equity. So it's really just two metrics. It's like, how much does the company make relative to its market cap? And if it spends £1, how much does it get back? Is it 50p or is it £2.50? And if it's So you just create a screen that says, okay, what's the most undervalued, and what's the most undervalued company that has the best return on what it sells, and then you rank that, and you invest in the top 10 of whatever index you're looking at, and you get some absolute gems, which is it's quite interesting because if you've been following that, I don't know if you saw what happened with GameStop recently.
Yeah. I kind of follow it. Yeah.
If you'd been following his methodology for the S&P, you would have had money in GameStop because it was undervalued with reasonable margins and that. So it's weird. You sort of tend to get these really real freak events that happen when you invest in his strategies. Because other companies sort of look at it, and serendipitously you end up with these buyouts and all these other things that happen because they are good companies which are undervalued. So
sounds like a good book. So from listening to what you're saying, it sounds to me like you are more of a guy who looks at fundamentals rather than technicals, or do you look at a combination of?
I used to do a lot of technical trading. So when I was early in my career, I did what's called long short equity, which is where you pick two stocks that are highly correlated, and you look for when they diverge in price, and then you sell the expensive one, you buy the cheap one, and you look for them to revert to the mean. So you're plotting a ratio between those two stocks, and you're effectively trading a standard deviation sort of model. So there's a bit of kind of support, resistance, the usual stuff you see in
but obviously more technical than that, more technical.
Yeah, so I mean, I did a bit of that, but I don't know. I think I've gone off technical stuff a bit more because I think it's good for short term, finding breakout strategies, and and the more people who are looking at it, unsurprisingly, if everyone sees that this was the low, and everyone's drawn that line on the same chart, everyone has their limit order at the same place, it becomes kind of self-fulfilling a little bit, which suggests that there is some basis to it, but. I'm not short-term enough now to really care about technicals so much. I'll just invest fundamentally generally.
So you're more a long-term value investor. Is that correct?
Yeah, absolutely. I mean, it just allows you when you're doing short-term stuff, you can't hold things for that long.
Which makes sense. Of course,
you get 10-15% return, you're okay with it, but. With stuff like I've got stocks that I've held, and they're 8 times what I sort of bought them for, So it's because the fundamentals are telling me they're still undervalued.
I think it was Warren Buffett who said that when you buy a stock, you want to buy it on the basis, like if the stock market closed down today, you will still be happy to hold it for 10 years. If the stock market said, okay, I'm closing today and I'm opening in 10 years time, would you buy the stock? So the question is, don't buy a stock that you have to monitor every week. Oh, it's dipping down. No, just buy it based on the fundamentals, understand the actual financials. Okay, so your company, I think you mentioned your company name before. So tell us more about your company. Like actually, how can someone get in contact with you? Like how can you actually help them to make more money? Because it's very, very interesting what you do.
Yeah, so the company that we founded is called Accru Finance. It's Accru.finance. It's ACCRU, then with the E.finance. And what we're producing, and we're in sort of build mode. We'll be going live in October. Is effectively an app. People can log in. They can download the app, have it on their phone, and it's a really, really simple way of just earning high yields on their investments. So. Just say someone they've got euros or they've got sterling or dollars, whatever it might be, they can deposit that onto the platform. They then get the option to invest in several portfolios, which are based in, they might have one might be this stable coin where the underlying asset is pegged to the dollar, and then we'll pay them a yield of 15% on that stable coin. Or it might be that they want to have exposure to things like Bitcoin or Ethereum, which are the big cryptocurrencies out there, in which case invest in those and we'll pay you a 7% return in Bitcoin or in Ethereum. So the whole platform has insurance wrapped around it. So that's something that's against hacking and these sorts of things, trying to improve the safety of it. And we're very keen to try and make it the simplest user experience possible, because there's a lot of quite complex decentralized finance going on underneath in terms of we're staking assets, we're lending them to other institutions, we're doing a lot of things like that. But
of course, yeah, you kind of leveraging the money in the background, right?
Yeah. So in terms of what the customer sees, though, it's a very, very simple user experience with a live updating. They can see their hourly earnings that are on the platform. They can see it in real time, interest accruing. So it's a very simple way of doing it. And I'm hoping it's also a way of engaging people in their finances a bit more, because if you log in and you see, well, I'm passively earning, £2-3 an hour, or whatever it might be, depending on what you've got invested.
Yeah.
It's just thinking, well, okay, well, how do I get that to £10 an hour, or whatever it might be. So that's the sort of thing we want to do, is just get people thinking a bit more, because long-term investing is great, but it becomes a little bit intangible. So if someone was to tell me, well, you've got this in your pension at the moment, and guess what, that's it's currently earning you X, that might get me to look at it a bit more often, or at least pay attention to it more. So
So what does a person needs to know about investing before they invest? I mean, what do you advise them to? I mean, is there anything for them to read about it? I mean, if someone would just want to invest in your company,
I would always do your own research. And the thing inherently with cryptocurrency, as safe as we try to make it, you can never call it a low risk investment. It's always at the moment, it's always going to be high risk, because cryptocurrencies are new. They are, they haven't been around that long, and there's a lot of underlying kind of uncertainty around crypto. So I think whatever happens, this isn't something where you sell your house and put it into crypto. It's this is just like for any other portfolio. It's a balanced portfolio. This is an element of a high risk element of your portfolio that you put some money into. And I think do your own research and have a look at these things. I mean, we try and simplify the decision with us. It's either you're investing in effectively US dollars with our stablecoin fund, or you're choosing to have exposure to one of the big cryptocurrencies like Bitcoin or Ethereum. So if you're, I think you need to make the decision. Do you want high yield and dollar exposure, or do you want 7%, which is still a high yield, but potentially the underlying asset could grow with the value of Bitcoin, or grow the value of Ether. So you've got to decide. And I think what we're finding is a lot of people are actually saying, well, I want 50% of my money earning 15% in dollars, and I want the other 50% in Bitcoin, earning 7%.
Yeah.
And that's kind of where people are.
Interesting. I mean, it's quite, I mean, a couple of things that you mentioned. So I think one of them, you said that it's high risk. I remember when I actually invested in cryptos, which was back in 2017, I did a half-day course with a guy up in Peterborough, right? And he said, look, this thing is going to blow. It's going to get big. Okay, even if you're scared, just invest, 5% of your portfolio. So if you have $100, just put $5 in Bitcoin. If you lose it, you lose it. You know what I mean? And I did go and actually and bought a couple of coins. You know what I mean? And because I thought, a couple of grand. If I lose it, I lose it. And actually, and it did went high. So I guess like what you're saying is kind of similar. Crypto is still a high risk area, so people should know that the potential gains are high, but don't put all your money into something like this. That's
exactly it. It's and I think a lot of people forget that. They see the big returns. They see Dogecoin doing however many 1,000% and things like that, and people get a bit greedy. But they, especially recently, it's been a bit of an eye opener for people, where they've been hit quite hard, I think, by this pullback that we've seen in crypto, which has actually done us a lot of favors, because we've seen a lot of people move money into their stablecoin strategies, which don't really get impacted when the crypto markets decrease. Activity decreases a bit, means our yields are slightly more difficult to maintain, but generally speaking, we haven't dropped from a 15% yield for anyone. So
it makes sense.
And there's retained your capital.
Yeah, and on the back of it, then, so when someone if someone invests in the US fund, as you said, or the US tracker, right? That if that person is in Euro or in the UK and then they invest in sterling, is there any currency exposure? So there is
at the moment there's currency exposure, but it's something that we're looking at. That we're launching with the US dollar account, because it's the easiest and the largest, most liquid market in crypto is US dollars. But there is the potential to do euro accounts and GBP account as your base asset. So we will look at those as well. I think the yields won't be 15% because you can get those on dollars, but you can't. It's more difficult to get on euros and sterling. But yeah, we'll absolutely be adding those accounts as well to try and, because at the moment there is that currency risk for people.
Okay, I understand. And I mean, so have you got a team in your company, or is it just you and a small team, or is it?
So it's it's been interesting because it's been trying to do this in a very lean way. So the core functions we've got in-house. So we've got 2 developers. So I've got a really experienced CTO who I've worked with previously. He's a very, very smart guy, and another guy I've worked with who's our chief engineer, Gary George. He's again a phenomenal engineer. So they are building the product and they're working at pace. But then things like finance in terms of getting payroll, all these things sorted, outsource that. So outsource payroll function and all those sorts of things. And month end numbers, those sorts of things like that. And then we've got a very also wanting to have in-house regulatory expertise. So we've hired a very experienced money laundering reporting officer. So we're putting a lot of emphasis on the processes, risk management, and regulatory rigor that we put around everything that we do. So, our head of compliance, 25 years experience, and they've worked at places like Aegon and Aviva, and also regulators like the FCA. So, really adds a lot of credentials to have them on board full time as well. And then, kind of marketing wise, we've in terms of getting out there, we've got a couple of agencies that we work with. So, in terms of the actual direct number of employees we've got is not very high, but we've got, in terms of the support we're getting from some very cost-effective third party providers.
Makes sense.
It's been working well.
So once this is launched, you said October, so anyone in any location can download this app and start to put some money on. Is that correct?
That's correct. We need to be careful from a regulatory perspective. So certain regions that we won't be targeting or allowing to come in. And at the moment, that's going to be specifically looking at the USA, Canada, and Japan. We're waiting. We've got an application in with the FCA in the UK, which will allow us to target everyone in the UK. And then the rest of the world, though, we've got people from all over the world will be able to use it from outside those locations.
That's pretty cool. Man, it was really, really great to have you on board here. I mean, I just got a final few questions for you. I mean, as a finance man, you're like running your business now. I know it's still in, if you want to call it, beta mode in some of the development phase. What are some of the key metrics that you look at, or some of the key things that you think, I want to know how this is going? I mean, obviously, you still pre-revenue. Am I correct?
Not quite. So we've got a bit of institutional money that we manage. So that allows us to be able to generate revenue sort of pre-product being fully live. So,
I
mean, our metrics are really simple, and I think we're focused on really just sort of 3, which is it's customer sign-ups and how they credit their accounts. It's assets under management, and it's the base return on assets that we're making. So
I got it. Yeah.
We're paying customers 15%, and then everything that we make in addition to 15% is what our margin is.
Yeah,
and
I got it.
That will vary with sort of markets. So
I understand. So your focus is to get more people to sign up, have more assets under management, get a higher base return, and then obviously things are going good. Obviously, makes sense.
Everything else pretty much looks after itself. And obviously, we'll as we grow and scale and our customer base increases, then it's looking at more of the finer metrics around kind of the number of month-to-month user growth, and how many times people are logging into the platform. Those
of course. Operational efficiencies, operational metrics. Yeah. Okay, cool. So I ask the question to everyone. So what does the term financial intelligence means to you, being a finance man especially?
I think it's just having your money in the most efficient place for yourself, and to achieve whatever goal you've set with it. So I could go on to explain that further, but I think that's sort of, it will be very dependent and very personal to you. But the worst thing you can have is your money spread around in places that isn't serving you. So trying to make sure that you've got your money in a place that it's doing what it needs to do to sort of support your longer term goals. That would be the.
I love it. Okay, so if someone wanted to like get in contact with you, like someone wanted to go like, this guy is like, wow, he's a finance guru, he's a crypto guru. I want to talk to him. I want to invest some money into his business. I mean, where can they find you? Where's the easiest place to find you?
So registering on they can send me an email directly to Phil, PHIL at accru.finance. They can find my book on Amazon store, which is the Money Triangle.
Yeah.
So drop me an email. Love to hear from people. We are still open to investment into the businesses as well. We've closed our first financing round, but we're extending it because we've had so much demand. We are still open to investors who are looking to take a stake in our business itself.
Yeah. And how much money can people invest as a minimum? How much can they, or maximum?
In the actual business, or in terms of?
Well, in the business and on the platform.
So on the platform, it comes down to our kind of regulatory sort of transaction monitoring requirements. So checking, as long as we're happy, there isn't really an upper limit. Minimum wise, I think we're starting at $100. So if people want to put money in, they can put $100 in, just to test the waters. And then in terms of like equity in the business, that's we're open to discussion there as well.
Okay, cool. So I guess your vision at some point in time will be like to, I don't know, like go to the stock market, or is there your vision?
I think so. We see a lot of companies in our situation are kind of giving investors liquidity very early by going to market and doing an IPO. So I think that's probably something that we would look to do in the next couple of years.
Cool. Phil, man, it's been great to have you on. Thanks for your time. Try to keep it within, 45 minutes to an hour, but it's been so insightful, so technical. I know for some people listening, they'll be like, what is this guy talking about? But of course, they can probably start by getting your book, I guess, The Money Triangle, which will help, and some of the other books that you mentioned as well. And hopefully they will learn a lot. And I have found it really insightful speaking to you. I'm actually interested in investing in the company, so I'm going to be following you as well and seeing more of what you do. So great to have you on, and I hope that we will keep in touch and speak soon.
Appreciate it, Royston. Thanks so much.
Take care. Bye-bye.
Thank you very much for listening to my podcast. I hope you enjoyed the show. You can find out more about me by Googling my name, Royston Cumberbatch. I'm on all the social media, Facebook, Instagram, and LinkedIn. You can find me on YouTube as Roy Cumberbatch. And if you are listening on YouTube, please hit that subscribe button, or you can find me on my website at www.racmacs.com. That's RACMACS.com. It'd be great to hear from you, and do feel free to tell me about any topics you want me to cover on future episodes. Until next time, be good to yourself and others, keep positive, and reaching for your financial goals. Bye-bye.